program is brought to you in association with First National Bank of Botswana.
FNB, how can we help you?
Welcome to First Issues. Buying property is one of the many investments that a lot of people wish to have, be it for residential or business purposes. But just like any other purchase, this involves having access to funding, which a lot of us look to financial institutions for, where we find various funding options. The most common of these, especially when buying property, is a mortgage. On the surface, this option promises a longer, more relaxed repayment agreement between the client and the financier. While this may be the case, there are some individuals who still find their properties repossessed for failure to keep to this agreement, leading to ever-rising auction sales in the newspapers by banks, high levels of unserviced loans due to individuals overcommitting their incomes, and overall escalating bad debt. Professionals such as our guest financial consultant Nelson Letshwene says such scenarios can be avoided by having a proper plan in place prior to acquiring mortgage financing. Our conversation with Nelson starts with him explaining in depth what a mortgage is.
Mortgage, what it is. Actually, the word mortgage comes from the French legal terms, which means engagement and basically a death pledge. So the word mort in French is death, and the word gage is from the English engagement. So basically, when you get into a mortgage, you are agreeing with the bank. It's called engagement until death. It is such a long-term thing, basically, that you might just die before you finish paying. It's unlike your 5-year loans or your car loans or personal loans. It is one of those. It's the only loan that can run for over 20 years. And it is such a long period of time. That is why, the French have just called it a death pledge. And that's basically what it is. You're going to be engaged with the bank, possibly until you die, and unless you yourself kill the deal by paying your mortgage faster.
Nelson, why is it important to have a mortgage management plan in place?
Mortgage management plan is a very, very important part of the whole process because it's such a long-term thing. You have no idea what's going to happen between when you sign the mortgage and the next 20 years. And of course, the bank that lends you the money looks at your ability to pay over 20 years. So they'll look at you and say, you are employable, you can still be employed for the next 20 years, therefore we will do this. But it's very, very important for you on your part because the bank is betting on you being employed, not so much employed, but your economic activity, your ability to produce an income over 20 years that they are willing to work with you, whether you change jobs along the way or not. But on your part, it is very, very important. Now, there's two ways you need to think about it. There's that mortgage which is for your home. And I think you should have a management plan for that because I would like to imagine that you probably want to pay that slightly faster. And there's a mortgage for a house, which perhaps you intend to rent out to tenants. The plan for these two is not always the same, but it's important that you have a plan because it is such a long-term deal for both of them. So your home, you probably want to own it faster, but the house that you intend to rent out, chances are the plan won't be the same as the first one.
You've just been talking about taking out a mortgage to either buy a home or a house. So maybe you could talk about the considerations that one needs to take into account when coming up with a mortgage management plan, especially prior to taking out a mortgage, which would make the plan more effective and, of course, efficient.
So that's a very good question, Panasar, because what you need to think about is, first of all, is time. It's a very long time. So you need to think about that and what could happen within that time. But the considerations that you need to have is, if death happens, then your house or your home could be in jeopardy of being repossessed. So that's where you take life insurance, so that should you die, the life insurance will clear the mortgage and your children can continue to still, or your relatives or whoever you want to pass the house to. That's one part. So it's time, and in addition to time, it's just the idea that there's death. And then, of course, there's other risks that you need to think about. The risk of losing your house to, disasters. So you need to have insurance, structural insurance that will cover that. And the next thing that you need to think about is, so there's 3 types of insurance: life insurance for the mortgage, insurance, structural insurance for the property itself, and of course the insurance for your household contents. So those are some of the things that you need to know, that there will be premiums for that. That's why that comes part of the plan. But the one thing that I really want to talk about is the risk of foreclosure. Foreclosure is when you have failed to pay your mortgage for a period of time, normally 3 months to 6 months, at which point the bank comes over and say, I am repossessing your home. So when we talk about a mortgage management plan, you need to manage those risks, okay? The first risk, the bank will take care of it, because they won't give you the loan unless you take a life cover, most banks anyway. So that one is managed from the very beginning. Property insurance also may be managed from that, unless you are building on your own, you took a loan and you are building. You need to think, I have a structure, therefore I must have insurance for that. So the one that is very, very important, that is often neglected, is the risk of foreclosure. What are some of the things you need to think about to make sure that should that risk come about, you are prepared for it? And those are some of the considerations you need to think about.
You've just been talking about bank action, which is your foreclosure and repossessions. How can one avoid such action against them? I mean, this may seem like an obvious question, but for somebody who may not know, perhaps you could explain that for them.
A lot of us think we know until it happens to us. There's no one who's in between. You know how they matters between.
Yes.
Nobody goes into matter between just saying wanting to get into matter between. We are in there because largely we were unprepared for that, or we didn't manage the risks that could lead us into that. And so you don't want to be in matter between with your house, where the bank wants to repossess and you are not able to do anything about it. So the first thing is, understand at what point would the bank want to repossess your house. That's the part you need to understand. The bank will repossess if you fail to pay for 3 months or 6 months, or if you are in arrears for about 6 months. The bank is very likely going to trigger the foreclosure clause. So you need to think about yourself and say, what can I do as a management plan to bridge the gap between, to make sure that regardless of what happens to my income source, whether I lose a job or whatever, I will still be able, while I am in between jobs, to service my mortgage. Because if you don't service it for a period of 3 months, or you are in arrears over 3, 4, or maybe 6 months, the bank is going to trigger that. So that is what the preparation is all about. So it's where the trick is right now. So then when you take a mortgage, you need to think, I'm going to pay the mortgage to the bank. That's one part. 2, I'm going to pay the insurances, the 3 insurances we spoke about. Life insurance, structural insurance, and household content insurance. That is part of the package. Now, another thing in managing the foreclosure is you need to be willing to pay an additional amount into a savings account, or some banks have something that they call, it's basically a savings pocket. You need to be putting money away for the risk period. So if in your profession you say, it's going to take me 6 months, should I lose this job? It's going to take me 6 months to get another job. That 6 months, it's a risk period. Within that 6 months, if you don't have an income to pay the mortgage, you could lose the home. Therefore, the additional payment that you are making to your savings pocket is to put 6 months worth of money for the installment into that account, so that while you are in between jobs, you at least have money to service that. That is basically, in a nutshell, I know it's a long-winded thought I am making here, but that is basically what goes into a management plan, a mortgage management plan.
When running a business means
Where did I put that receipt?
we can help you with instant accounting, free software that does your bookkeeping for you. When running a business means
Wait, what do you mean the container hasn't arrived?
we help protect your business from risk with Mohwebi Insurance. And when it means
How do we pay our staff that don't have bank accounts?
we help you make multiple payments directly to people's phones with e-wallet bulk send. At FNB, we're constantly innovating to help business owners at every stage of their journey.
Seeing that financiers actually have so much more to lose themselves when they lend out money to clients, is there a way in which they could help individuals come up with their own mortgage management plans which are tailored to suit one's individual needs and circumstances?
Most banks, like I said, they will have something that they call access bond. Some banks have access bond. Access bond is when they say, if you paid any extra, let's say your mortgage is 5,000, but you pay 5.5, they take the 500 and put it in a savings pocket instead of taking it towards the mortgage. Now, it's important to let that happen. Sometimes people say, no, I'm paying extra so that I can finish early. And I think it is very dangerous to try to finish early without having that risk covered. And that risk is the bank will say it's an access bond, or some banks will say it's a savings pocket. Use that pocket or that access bond to be able to save money into that account until you have, say, 6 months worth, or whatever long it takes for you. It might take for you to get another job. So that pocket is very, very, very important to fill it up. So if your mortgage is 5,000, 6 months worth of savings would be 60,000. Right? So, something like that. Okay. So basically what you would need to do is, it's 30,000, right? My mathematics. So if you are paying 10,000, 6 months would be 60,000. But if you're paying 5,000, it's 30,000. So that 30,000 must always be available, so that should you lose a job and you look for another job, out of that 30,000, you can pay month 1 and month 2 and month 3. And then you are avoiding the risk of foreclosure. You are avoiding the bank saying, you haven't paid us. I always try to remind people that the bank generally has a 3-month memory. And it's very important to think about that very clearly. Even though you've been with your bank for 10 years, they only want to know what happened the past 3 months. Okay? Yeah. And if in the past 3 months you skipped your installment, you are in arrears, you are in default. And as soon as you enter default, they will take action. So that is why the management plan is very, very important for you to consider exactly what goes into it and what are the issues that you need to put into that.
Nelson, you've just alluded to, cutting your repayment period in short or in half, really. So seeing that mortgages are usually tailored to be to have long-term repayment plans, usually 15 to 25 years, is there a way in which one can shorten that period to make sure that the repayment plans are completed in a shorter amount of time?
That is where we come up with the separation between a home and a house. I would think that your home, you would like to finish that earlier. So you would be able to have a savings pocket for your home. Let's say, let's keep working with a 5,000. You have a 30,000 put aside. Now, when you have the 30,000 put aside into a savings pocket, now any amount of money that you pay extra can go towards finishing or towards the capital or towards the loan. But then you'll have to talk to the bank and say, okay, my savings pocket has 30,000, which is 6 months worth of installments should I fall behind. But from now onwards, I want to be able to pay that extra 500 towards the mortgage. That will help in speeding up the payment of your home. So most people want to speed up without the savings pocket. I think that's a mistake, because even if you push, let's say you had a 20-year mortgage and you have pushed, there's only 4 years left. And in those 4 years, there's a 3 months period where you can't pay, the bank will foreclose, regardless of what you've done for the past 16 years. All right? So it's very important that you make sure that your savings pocket has enough money to cover other installments, and then you can start going after the capital. Once you have done that, you go after the capital. Any extra money that you want to do, you can do that. You can put it into the capital, and it will reduce the amount of time that you are going to be owing the bank. So it can move. So you can make a decision, make a plan, and say, I'm going to do a 12-year plan. If you're going to have a 12-year plan, you calculate, what do I need to increase my installments by to finish this in 12 years? Before you go towards that, you fill in your savings pocket first, and then you go after it and finish it off in 12 months. That, in 12 years, that would be your home. Now, for a house that you are renting out, it is not necessary to be in a huge hurry, because hopefully your tenants will always be helping you with that one. You know, the tenants will pay, and you'll be able to pay the bank. So the plan might be different. So your home, you might say, I'm putting my home on a 12-year plan, and my house that I'm intending to use as income for my retirement, that can go for 20 years, because then when I'm ready to retire, all the rentals will be coming to me. I won't be sharing that with the bank. So that basically is a way to start thinking about it. But for either home or house, you must think about all the levels that are important for you to think about, as in the risks, risk of death, risk of destruction, risk of somebody breaking in and stealing your house, and risk of foreclosure. That's very important to consider.